how business giants get lower interest rates for meeting diversity quotas. Racist credit agreements are incentivizing illegal hiring practices across corporate America. Now we just need the court to strike that shit down like they're about to strike down affirmative action. So, amid an uptick of race-conscious hiring programs throughout corporate America, many prominent businesses are now writing racial and gender quotas into their credit agreements with banks, tying the cost of borrowing to the company's workforce diversity. A Washington Free Beacon analysis has found. Yeah, this is like literal bribery at this point. So the businesses have struck such agreements include the pharmaceutical giant Pfizer, consulting group Ernst & Young, and AECOM, insurers Prudential, and definitely financial private equity firms BlackRock and the Carlyle Group, the technology company Trimble, and the telecommunications giant Telefonica. Yeah, these companies are going to have to start doing things the old way, where they didn't operate entirely off of debt. Like, that would be ideal. So over the past 2 years, each of those companies has secured a lending agreement known as a credit facility that links the interest rate charged by banks to the company's internal diversity targets, creating a financial incentive to meet them. So if the business achieves its targets, it won't have to pay as much interest on the loans it takes out. If it falls short, it is required to pay more. Now, how about the economy kind of taking a shit? How's that going to affect things, I wonder? So under the terms of BlackRock's $4.4 billion credit facility, for example, Wells Fargo will lower the firm's interest rates by 0.05% if it hits two benchmarks, a 30% increase in the share of Black and Hispanic employees by current year plus 2, and a 3% increase in the share of female executives each year, or hike the rate by the same amount if it misses both. Now, 0.05% doesn't seem that much, but on $4.4 billion? Now, the agreements, which typically involve multiple banks, are effectively credit cards for businesses. Rather than making a one-time loan, lenders extend a continuous line of credit that companies can dip into at will, either to cover operating costs or as a rainy day fund for emergencies. This means changes in the facility's interest rate, even modest ones like BlackRock's 0.05% diversity adjustment, can have an appreciable effect on the business bottom line. All you need to do is get rid of like one bloat employee, and that'll more than counter that. What about an audit on BlackRock? Who do you think is going to do the audit? The companies have advertised these agreements as proof of their regressive bona fides. Trimble CEO Rob Painter, for example, said the company's credit facility, which conditions interest rates on percentage of female employees, and illustrates Trimble's commitment to gender diversity in the workplace. Your commit is to failing. In a press release announcing their own credit facilities, executives of BlackRock, Prudential, and Definity say the agreements demonstrate their commitments to accountability. But critics see something far more sinister, a form of blatant discrimination that will harm consumers, credit markets, and the rule of law. Now, honestly, since it's the financial markets that are responsible for a lot of this mess, I look forward to them crashing in the future, hopefully very soon. So if a bank penalized a company's credit rating because it has too many whammons or was too racially diverse, would we be appalled? Said one senior government regulator who managed a 9-figure credit facility as a lawyer in a private practice. Now, this is the exact same thing, except the penalized target is white men. That's not wrong. And you know what really gets me? It's pretty much clear now that if you're a white man, you're not long for the corporate world. It's the whole environment's getting more and more hostile towards you as time goes on. In a few years, you're not even going to be able to get a job at this rate unless you make your own. So what do you think is going to happen in the future? So all the white men get chased away. They make their own. The old industry crumbles and dies. And the same people that chased those white men away are going to be showing up with their hands out, asking to be led into the new one they created. And then it's going to be totally racist and sexist of them if they refuse. Like, I'd rather not deal with the people that kicked me out of the old industry and destroyed it. Racism! Yes, mostly white men are writing this crap. Yeah, that too. Yeah, it's actually mostly white people in general that are spreading this racist shit. Yeah, they're the ones that no one's going to want around. So the credit contracts will divert resources away from consumers, critics say, and towards diversity initiatives where the promise of discounted loans will encourage the use of illegal hiring quotas. It's not illegal until it makes it to the court and the courts actually fucking enforce it. Then you can say it's illegal. So they will also hurt companies that don't negotiate a diversity discount on their loans because those firms face higher borrowing costs than their competitors. A dynamic that could steer entire industries towards race-conscious policies. Or even better, what if it steers entire industries away to alternatives to the existing financial system? That would be ideal. So let's say Wells Fargo will loan to BlackRock at 1% if it meets its diversity quotas, and the market rate is 5%, said Will Hild, executive director of consumer research. Every other company has to borrow at 5%. Now it's a disadvantage vis-a-vis BlackRock. So other companies have to follow BlackRock's lead, or they will go out of business because BlackRock will be able to subsidize its products through Wells Fargo. Now, on the other hand, if everybody did this, eventually the banks are the ones that would run out of money. But if that ever happens, they're just going to steal it from the taxpayers via the government, though. They're just going to be bailed out. All right, so BlackRock, Wells Fargo, and Bank of America, which manages credit facilities for Trimble, Carlyle, and Pfizer, did not respond to requests for comment. Yeah, they don't want to give any ammo to the coming lawsuits. So the contracts present present a new twist on the environmental, social, and governance, or ESG-linked loans that have proliferated in recent years. When the banks lend to businesses, they typically base interest rates on several factors, such as a company's cost structure and to debt ratio that drive credit risk. Since current year -5, however, some banks have also factored in ESG considerations, a borrower's carbon footprint, for example, in addition to the ability to pay back the loan. And all banks that do this should be replaced with better alternatives. And maybe that alternative is going to be don't rely on credit. Stop going into debt. So with diversity quotas in the mix, that gap between credit risk and credit access has only grown. There's no evidence that diversity makes a borrower likelier to repay its loan, the government regularly said. It's like handing out credit based on astrological sign. Well, that's basically what this race hustling shit is. It's current year astrology. So when a bank lends irrationally to one client, the regular added, it inevitably makes its loan terms less fairly priced for everyone else. And see, they know they could get away with it because remember the subprime lending crisis? A lot of these banks should have been allowed to fail when that happened. But no, they got bailed out. And the same thing's going to happen here. When these banks eventually face a reckoning for their stupid lending decisions, they're just going to get bailed out by the U.S. government stealing our money to give to them. The credit deals come as race-conscious programs are exploding across corporate America and sometimes in the company's own faces. That's the best kind. So Pfizer, one of the businesses that has tied its lending cost to diversity, was sued in September over a prestigious fellowship that bars white and Asian applicants. Programs at Microsoft, IBM, and Google use similar criteria, as do American Excuse and Amazon, both of which are now facing civil rights lawsuits. Yeah, if you're a white guy and they racially discriminate against you, fuck yeah, sue them. So let them fire you as long as they pay you enough money to live the rest of your life without a job. I think that's a fair trade. The race-conscious loans will encourage such policies, legal experts said, that would expose companies to legal liability. Hey, that's their choice. But even if businesses don't adopt overt quotas, says Adam Mortara, a prominent civil rights litigator, the agreements could be used as evidence that the firing of a white or Asian employee was racially motivated because of the incentives this kind of race-based discounting creates. Yeah, especially if you were replaced with minorities. So that said, it's not clear whether the contracts are illegal in and of themselves. There's no federal civil rights law that directly bans discrimination in business loans, 3 lawyers said. Unlike discrimination in consumer lending and employment, the lawyers were divided on whether the agreements would hold up in court. I think it depends on the judge, if I'm being honest. So you could argue the agreements themselves are permissible as long as the businesses reach their diversity targets without violating civil rights law, which is literally fucking impossible. If you weren't naturally meeting those targets before this racist shit was implemented. Said Hild, who was also founded the public interest law firm Cause of Action. Of course, if there were a way to do it, they wouldn't need these agreements. Yes. Yeah, this is typical leftist shit right here. They know that their ideas can't survive in a free market, so they have to manipulate it. Other lawyers said the contracts create such a strong incentive to discriminate that courts might strike them down if a business cannot boost its minority employment through race-blind means, said James Copeland, the director of legal policy at Manhattan Institute. Hard quotas will be the only way to avoid losing money under the terms of the lending agreement. So this is an implicit violation of Title VII. A lot of prohibits employment discrimination. Copeland told the Free Beacon it has to be illegal. Oh, it is. But I guess the problem is men, when they're discriminated against, and white people are usually severely discouraged from taking this up to court. So you just got to ignore the rest of society trying to shame you and get what's rightly yours. So credit facilities are the product of complex confidential negotiations between a company and its lenders, making it difficult to know which party proposed that provision. Though all clauses must have a sign-off of both banks and borrowers. So it might seem odd for businesses to risk a choice between breaking the law and hurting their pockets, but an odd still for them to celebrate it. But if a company is ideologically committed to its quotas, Hilt said, the credit deals can make a kind of circular sense, both economic and legal terms. And wouldn't it be fucking hilarious if, as the pendulum swings back the other way, they find themselves stuck in these loans that they can't back out of? I look forward to that. Now, economically, the company gets a discount for a policy that was already going to implement. Legally, it gets a shield against shareholders who see diversity initiatives as a drag on business performance, because under the terms of the loan agreement, more diversity means lower costs. Yeah, even as they say for every dollar they save on the loan, they lose 3 to customers fleeing. But that's okay. A lot of these shareholders are pretty dumb. So the company can argue that diverse policies make borrowing less expensive, thus fulfill its legal obligation to shareholders, said Dan Morinoff. Yeah, that's probably the main reason they do this. The executive director of American Civil Rights Project has filed shareholder losses against corporate executives over their race-conscious programs. So the counter-argument Morinoff added is that these policies are very valuable to civil rights complaints. If a court enjoins a company's race-conscious programs, it might not be able to meet the diversity targets specified in its credit agreement, in which case the cost of borrowing would go up. The calculus is similar complex for banks. On one hand, lenders will make less money if they loan to businesses at a discounted rate. On the other hand, Hilt said, linking the discount to ESG objectives, including diversity, may boost a bank's ESG scores, thus attract capital from ESG investors, some of which, like BlackRock, are themselves the recipients of ESG loans. Oh, are you saying that this is like a circular bribing? Yeah, this is a bribing circle jerk right here. They just pass the same money back and forth. So the private equity firm also owns 7.1% of Wells Fargo, the bank managing its credit facility. No conflict of interest there, and likely holds stock in other participating lenders as well. So Morinoff said, so when BlackRock secures an ESG loan from those banks, it may be directly boosting the value of its own equities. Now, this should be fucking illegal right here. Like, now this needs to be investigated. So the result, if nobody sues, is win-win for both lender and borrower, which happen to be the same person sometimes. The losers are innovators, pensioners, and the consumers who will bear the cost of a distorted market, which is why you need to know what's coming and prepare accordingly. So the purpose of bank lending is to allocate capital to its best use. It could have better products at lower price. Hilt said, if you subsidize diversity, you're focusing the market on other things. And they don't care until it bites them in the ass, to be honest. That's right. Can't probably won't happen. Any government you can think of is corrupt as fuck. Oh, yeah. Now, part of the circle is the government as well. Like, that's why regulations don't work usually, because it's like a revolving door between politics and these companies. And if you look at who's regulating those companies, they're like the biggest presences in any given industry are basically regulating themselves.